Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. Today, Jez, property versus shares. We've done 3 parts to the series.
Yeah, well, there's a lot to talk about, a lot to cover. So we split it up into 3 different parts. This one, we're going to lay the foundation.
So the basics and our experience. So as we always say, there's visual aids. So on any of our podcast platforms, you can view all the content. This one took a fair bit of time. It wasn't a
More time from you than me, but you've done a great job.
Yeah, I came up with the presentation and then you said, no, Damien, no. I'm like, this is taking a while, Jez, but that's what we want to do. We want to, with this series, we just want to come from our perspective, but hopefully back it with a little bit of data. And you made some really good points when we sort of went over it. But let's start, because the whole idea with this is to help listeners understand, I guess, key differences between property and shares. And disclaimer, the information provided today is general in nature and does not take into account your personal financial circumstances, objectives, or needs. Please seek professional advice before making any investment decisions. So,
can I just say, we are property people, so there's probably a bit of bias here. We've tried as best we can to be unbiased in this comparison, but yeah, we sell property data.
And we just hope people find value in it. I think that's the whole idea, because I have this discussion a lot. It'd be great to go to these episodes, have a listen.
Yeah. And you know what? After looking at all of this information, all this data that you put together, I thought property was going to kill shares, but
we'll see the numbers.
Let's see.
More in episode part 2 of the series, we'll break down the numbers.
Yeah.
But I guess let's start out with our experience. So obviously we're both property guys. It's what we live and breathe. Like, we love the data, we love the information. We've been investors for a very long time. But how did you get started, I guess, in shares?
Yeah, well, I was a contractor in IT, and I had a bit of coin banking up there, and I thought, where am I going to put it? And some very simple research that I did online suggested that the share market had outperformed property, so I decided that was for me. I was going to invest in shares. And I just really didn't know what I was doing, so I had to read some books. I had to go to seminars and webinars, learn everything I could. And I ended up writing covered call options over some blue chip stocks. I'd buy some shares and then write the covered call options over those.
Was the whole idea with starting just to build wealth for yourself? Is that what you're...
Yeah, exactly it. Yeah, look after my financial future.
Yeah, so from my experience, I did my commerce degree, I did finance, accounting, and don't know how I got through accounting, but I passed. I was better at finance, but I ended up doing my financial planning diploma also. So I did my commerce degree, finance, accounting, financial planning, done my real estate, got my forklift license. That was a long time ago. Did a bit of stuff in hospitality a very long time ago, but it was with the property side of things, shares. I did in my finance degree, but it was very technical analysis. You have fundamental, technical, but where I really learned, I think, is from experience. Once you dive in, be it with property or shares, you can have your own opinion or idea, or grab, I guess, the property performance over a 10-year period versus shares, or 20-year. You can make something suit you better to argue. You know, like I bought a property 10 years ago, it killed the share market, whatever it might be. So it's really important to look at, I guess, what do you call it? Regression analysis?
Oh, yeah. I think you might be referring to resampling, just cross-validating. Does this pattern work in every era, that sort of thing? Yeah.
But back to my experience, working with a lot of clients, I would normally see their finances, and you'd always see a little bit of shares in there. I'm like, what's your strategy? I don't really have one. They just buy because they got a tip or they heard something. But that was like really my experience. And then I did, like, obviously in the later parts of the series, I'll talk a little bit about my experience. And, you know, I've underperformed in the share market, and I did work in with a financial planner. But that's how I sort of got started in the whole shares. I just wanted to diversify away. And again, I won't go too much into it in this episode, but the experience that I had where I bought before COVID and I got hit pretty hard. But again, I guess I did it at uni, had a bit of a dabble here and there, but really started getting into it when I sort of wanted to diversify. But that's really my sort of experience with it, I would say.
Yeah. But so are you saying that you invested in property before you invested in shares?
No, I had property before, and then shares was a little bit after, but it was just like dabbling. Like I had no idea what I was doing. Bought a couple of Westpac shares, bought a couple of these ones over here, these ones over there. And then I did working with a financial planner. And again, I think we'll talk more about that in our part 2 and part 3, the experiences that I had. But very interesting because I thought you go to a financial planner, they can easily outperform the averages, and I found out that it's not like that, is it?
Yeah, well, there's got to be winners and losers. Everyone that's in the share market is an investor, and half of them win, half of them lose.
And I think with any financial plan, if you do work in one, what's your performance? Are you beating the index funds? Are you beating the averages? Have you got numbers to back it up? Even with the buyer's agent, are you outperforming? These sort of things, there needs to be a lot more clarity in the industry way down the track. So that's my experience. Again, I worked in accounting and then also got my QPIA. Now, QPIA I won't talk too much about as a qualification. I guess starting out, it's not really relevant to the whole share thing, maybe more property side of things. But I was always thought initially it's something that you needed. I need a QPIA, and I just find that it most probably, what am I looking for here? It's not really something that you really need. It's just, it sounds nice. Oh, hey, I'm a QPIA. I'm qualified. But I've seen QPIAs.
Stands for?
Qualified Property Investment Advisor. But that's just something shiny to say, I believe. Like there's a bit of education, but it's like pretty much what a made up course. There's really no regulation.
It's
there?
Not government.
It's not regulated. And the problem is you've got these maybe firms out there that sell garbage assets or off the plans and they're QPIA. So people think, oh, this person's QPIA. I trust them right away. So look, I'm going to talk about that in maybe a future episode, breaking the QPIA down from our perspective. Not to say it's a bad thing to have. It's just more about just be wary. All righty. So which one builds wealth faster? So I guess property shares, the answer can be different depending on who you talk to or the data that you look at that we've discussed. I think it really comes down to what are you comfortable with, property or shares?
Yeah, and where your experience lies.
And education is a big part. So if we go down, let's have a look. So it's time for us to, I guess, look at the data. So you've got like this whole thing, short-term versus long-term returns. Okay. So let me just bring up the pointer. Short-term, long-term, the leverage impact. So I guess short-term, long-term. So property grows steadily over time, but you obviously highly leverage it into one asset. Where I guess with shares, you've got a bit more of that diversity because you can pick and choose and you can start. But we'll talk about pros and cons shortly. But I think with the leverage impact, yes, you can leverage property. But one thing I didn't really consider too much, I did have like margin loans previously. So which is you can get lending.
Yeah, me too. Yeah, I had no idea you could get such a high LVR, but we'll come to that.
That's right. And actually, it's surprising when you do look at those numbers. So margin lending's obviously there, but it's obviously risky due to margin calls. So like if the LVR drops below a certain point, you may need to liquidate some of your stocks.
Just at the wrong time.
Or contribute extra cash. And there's no real margin calls on property. Have you ever heard of that? Like, let's say you buy a property at 80% LVR and that property value plummets.
I've never heard of that, no.
I've never heard of it, but I guess the bank could do a valuation and go, whoa, like your 20%, your LVR's 100%.
I'm pretty sure I've read through some loan contracts and noticed they have the power to ask you to do that, but I've never heard of it happening.
Like I've seen some clients have an LVR over 100%.
Yeah. Like
not talking about like doing an equity release. Like I'm just saying 80% of the property value and then the value of the property plummets. And then, let's say it's worth 500,000, but now the debt level's 520,000. It's more than what it specifically is secured against that one property. So typically very rare, but it can happen.
Yeah, but in the share market, no question, as soon as it happens, some of your stock is automatically sold down by the margin lender.
And I think other considerations, I think like franking credits, which we won't talk too much in this episode about, and depreciation with property, I don't really call them, look, you could call them, no, they're not benefits. They're just something that potentially can help with cash flow at a certain time, depending on your tax brackets and whatever it might be.
Yeah, well, definitely it's not a benefit depreciation when it comes to property. I mean, appreciation is a benefit. Depreciation is a detriment. But yeah, you could argue franking credits are a benefit.
And the other thing with, I think, risks around like property and shares, and then flexibility, like with property, it's obviously a lot more to get in, a lot more time injection to buy a property, to sell a property. Shares, you can sell right away. And one thing I found from my experience was when I really started getting into the shares is I like diving in deep with it. Like you get analytical. It's like, there's got to be a way I can beat the market, and you get absorbed with it and you look at prices every single day. And I'm like, I'm burning so much time here, but it was addictive. It's just the personality that I had. It was just very addictive that I needed to see how it was going every day.
Yeah, I think, it comes down to the mentality of the individual. Can you buy shares with a set and forget mentality, or do you want to be more aggressive, more active?
I'm all about freeing time these days. So these days I'll sort of just let it go. But that's where I think index funds have a part to play. And index funds, there's a lot of popular ones in Australia, like the VAS, for example, is a Vanguard index fund. We don't get paid by Vanguard or anything like that. I'm just mentioning because it's popular. And a lot of finfluencers, I think they call them. Finfluencers, people get online talking about finance, that they're finance license creators, which means they've got a diploma, or they've got some certification, or they work under someone's financial planning license. They call themselves licensed financial content creators, something like that.
Wow,
I'm going to be looking at that in future episodes. But we obviously got to be careful of what we talk about. We can't give any sort of general, personal advice, but we're also got to be careful on sort of general information that we provide too. But back to this, I just got addicted to the stock market. It was, but now I'm a lot better with it. Now, passive and active investing. So with property, you buy it, you forget about it. Passive. Active, I want to get in there, I want to renovate, I want to get my hands dirty. That is a bit more active approach. Even buying and selling, you buy in, get your capital growth, offload the property, go again, which is something I know that you've worked on a lot about trading property. And we're going to be talking a lot about that in the future, about trading, because I think there's something in that.
Oh yeah, it's just a natural evolution of property investing. That's a change brought about by artificial intelligence, by data.
And who each asset class, I guess, suits. Like it can obviously suit different people, as we mentioned before. Do you want to be hands-on? Don't you? Do you want to learn? Like a lot of people are interested in learning. But again, with shares, I found everyone's got their own way. I'm not going to beat the market. And if I do, I might get lucky.
Yeah. And with property, like let's say you're a tradie, you're a bit of a handyman, you might find flipping properties, doing renos as being something handy. Or if you've had some background in subdivisions or whatever, or developments. So it depends on what you experience.
You've done a couple renovations, haven't you?
More than just a couple. I remember after the first couple thinking to myself, I'm never going to do that again, and doing maybe a few more, 3 or 4 more.
Let's have a look at the pros of property investment. So we've got leverage and capital. That's the one thing that we obviously love about property. Control and flexibility. We can pick where we're going to buy. With shares, you sort of you can't really control the companies, can you?
You're talking about choice. The only control you've got is choice. But once you own a property, you can
value add.
You can value add. You can rent it out per room. You can do some simple renovations. You can landscape. You can subdivide. So there's a bit more control.
I think areas you're obviously going to invest in have low vacancy rate, which means that you don't want your property to be empty for a long period of time. So rental income, I find in property, is very stable. Like that cash flow is coming in, where with shares, specifically if you're a bit more of an active trader and you buy specific stocks, potentially dividends might get cut. So you might be expecting to get a dividend, and then all of a sudden the company doesn't pay a dividend. And a dividend is when a company, let's just say Commonwealth Bank as an example, pays out their profits to their shareholders. They might go, you know what, we're struggling and we want to grow our business. We're going to stop paying you the dividend or reduce the dividend. We're going to leave it within the business. So that's how, and a lot of business owners can obviously pay themselves a dividend or leave it. A lot of small business owners typically leave it to grow their business.
And the other issue there is that your rental income is coming in each month, whereas a dividend only gets paid twice a year.
Twice a year, or some like index funds might do it like quarterly. So the bundle of like the VAS, the top 300, actually I didn't mention, like the VAS is the top 300 companies all bundled into like the one index fund that you can buy. So it's, you buy for it and you get a lot of diversity by buying this one fund or index fund. So I find that over time the dividends are quite consistent with those index funds, those solid index funds. Rental income, tax. Look, would you call it benefit? I wouldn't maybe call it benefits. I'd just say like depreciation or negatively gearing helps you through, especially through your accumulation phase. When you're buying property, let's say you buy a property and it's costing you $500 a week out of pocket. You can utilize that to negative gear, obviously bring your taxable income down. So you're not actually $500 out a week. You might only be out $350 a week. Not only, but it helps with cash flow.
You can have a negatively geared share portfolio though.
You can. Yeah,
that's the same laws apply for business, property, share investing. It's just declare your losses. If it's if there are more losses than cash flow gains, it's negatively geared.
I would say that the net yield is lower on property if you look at it overall, like compared to like an index fund, like the net yield, because you've got to factor in maintenance, repairs, council rates. Like you need to factor all these numbers into the cash flow, into the return on investment figure. Because a lot of people that are pro shares going, you're not factoring in this, that. We factor all of it in. When you look at that ROI number, you factor it all in. The only thing you're not really factoring in is your time. How much time am I spending on my share portfolio? How much time am I spending on my property portfolio?
Yeah.
Like how much time do you spend on your property portfolio, Jez?
Every now and then a property manager will call me and I'll say, just get it fixed.
I'm like, anything under $500, I don't want to hear about it. Typically, just do it. Less volatile? Property, would you say less volatile?
Well, when you're talking about an index fund, probably is still less volatile.
I'd say less, like for example, like around that COVID time, the share market got hit and crypto did at that time too. There was a bit of a dip during that period, but it happened rapid where property didn't really get hit that quickly.
No, property does seem to be much more stable, and that's probably why you can get higher loan-to-value ratio.
I think one great thing that's maybe not touched on a lot for property is maybe for savings. So interest only for a lot of people is the way to go when they talk to their broker or get advice. They go interest only, one, to keep their investment debt level higher. So if they've got their owner occupier, for example, they want to pay that off. It might be P&I. They might be reducing that debt on that property, but they don't want to pay down their investment debt, because why would you pay off your personal debt and investment debt at the same time? So what a lot of people do is they pay down their owner-occupier debt and keep their investment debt at interest only, so it sort of flatlines for a long period until their home gets paid off, and then they can go start filling up their buckets in their offset account. That way, it's the best for your personal cash flows, doing it that way, because you're getting full deductibility on the interest on your investment loans. Now, another scenario is, let's say you're renting, you've got an investment property, but you're a horrible saver. You just buy new cars, you just very, impulsive. You don't think, you just do, okay? I don't think principal and interest on an investment property is the worst idea, because it forces you to save. Otherwise, if you put that money in the offset, what are you going to do? If you see it, a lot of people can't control. They spend it. And that's one of the big parts of property investing and any investing is you need to be on top of your cash flows. You have to be. And I think it's important to factor things in your holidays and live for today and still enjoy, but have that balance of how much am I allocating to my investments. But that's where I think property is good. It can be a forced savings if you are on principal and interest, because you're building up equity in the property.
Out of all these hundreds of clients that you've had in the past,
Thousands.
sorry, how many of them would you say have been in a position to buy an investment property, and yet you can tell this is an individual who just spends?
I've seen it, but a lot of them, when they come talk to us, they're ready. Like, they're ready to make the change. So it's very easy. It'd be the only time I'd find pushback is if you've got a couple and they're not on the same page. One person wants to invest, the other one doesn't. Like, there's obviously a relationship challenge that they need to sort out. But I would find that a lot of people are in a solid spot, and if not, like, I've had people sell their car to sacrifice trying to get into the property ladder earlier. They know they've made a mistake. Look, I got a lease, or I bought a car brand new. You know what? I really want to get a property sooner. I'm going to sell down that car, buy something a bit smaller, and try and get into the property market. That's the key. Early on, you need to build up your cash as quick as possible to fund the deposit. There's no magic recipe to it. Like, all these influencers out there, Instagram, social media, that make it sound very easy. It's at the start, it's not. There's a grind. You got to go through some pain. It's a part of life, isn't it? You need to go through some pain, and everyone has their struggles and sacrifice to get there.
But so there wouldn't be a case where there's a client where both parties, husband, wife, whatever, are impulsive buyers, and they're in a position where they can invest in real estate.
You do, yeah. A lot of people do have the car, and they do have, maybe they've got their owner occupier. A lot of the time, they've got their owner occupier that they can leverage from. So they go, okay, look, we've got a little bit of equity. Let's release that equity as an investment loan to be able to fund the next property purchase. So I think it's, like I said, it's all about balance. I'm not against getting the car, but if people come to me saying, I really want a property, but then I remember once there was someone that came in and she had a $100,000 car, and I'm like, but she wants to buy a property. I'm like, well, why'd you buy the car outright when, and I never heard from her again. She didn't like the pushback that I gave back to her on that. But that was a one-off. A lot of the time, people do make sacrifices and move things around to make it happen.
Yeah, okay.
But back to the point, it's a forced savings for a lot of people. But the thing is, one thing I can't change, or you, Jez, or anyone, is the impulsive behavior. Like, I went through a period where I used to spend a lot of money too, but you got to change your habits. So I'm not saying sacrifice your whole lifestyle. There's just maybe an initial period where you put your head down and just save to get to that property. Hedge against inflation. I think, I guess property and shares are the same for that. Refinance and equity releases. This is an interesting one. So with property, you can refinance. So let's say your property is worth $1 million and you've got $600,000 in debt. You might take $200,000 as an equity release, as an investment loan, to go buy a new property or buy a car or start a business, whatever you want to do with that equity release. That's your call. But I guess with shares, you could liquidate. Like, if you leveraged shares with a margin loan, like, you could liquidate and get your money within 2 or 3 days. That's sort of like, I guess you're liquidating, so I guess you got less exposure to the asset class if you are selling down then, aren't you? But you could sell some stocks down to start a business if you do leverage.
Yeah, well, that's always the big pro for shares, isn't it? The liquidity.
Well, a lot of the time when clients come through, I never really see many people take on leverage for shares. What they would do is they'd have their maybe property, or maybe they've just got some shares and that's it. They never really had a strategy. They just go, oh, I thought I'd just buy some shares.
So there's no margin loan against them? They
bought some stocks, went through a broker, I just bought some stocks. I just thought, I'm like, oh, what's the strategy behind this? And a lot of people just thought, I just want some exposure to shares.
Okay.
Yeah, which is, I think, again, it just comes down to what your strategy is. High borrowing power. So obviously the banks look more favorably on leveraging with property. You can go up to, you could go up to 95%. You'd get hit pretty hard with lenders' mortgage insurance, but they are willing to borrow more compared to shares.
Yeah, and I think the relative LVRs, loan to value ratios, shares versus property, is a direct reflection of the stability, risk, volatility of both investment vehicles.
No daily market fluctuations. I think we touched on that with the volatility. The cons. So What's your time worth? I guess that's one. So I think, do you do it yourself? Because a lot of people get lost. You can do it yourself or a buyer's agent, or you could do a property course. Now, doing a property course, you're still taking up your time and you're only looking at one person's perspective on how they do it. They've just done a course based on what they're saying.
Unless you do multiple courses. More time.
You do multiple courses, but it's like, who's right? Do I believe this way? Do I believe this way? And that's, I guess, the whole idea with the algorithm that we've got is shortlist first. That's the key. Like the algorithm does a lot of the heavy lifting initially, but back to this point is like, what's your time worth? How much time are you injecting in this with the busy lifestyle that you've got?
Mm-hmm.
So I would say just you need to factor that. It's a liquid, so you just can't sell a bedroom right away.
Yeah, you can't change your mind.
So if interest rates go up, sorry, Jez, you can't change your mind, you were saying?
Yeah, you can't just change your mind. You need to, this property investment needs to work for at least a couple of years.
A good example would be, let's say, maybe 3-4 years ago when rates were around the 3% interest-only investment loans at 3%. My microphone keeps going up, so apologies for that. But around 3%, you could get a lot more lending back then. You had a bit more flexibility, and then all of a sudden these rates were climbing up and people were feeling the pinch. But you can't sell down your property. You can't go to the bank to get an equity release, so you're really stuck. And that's where I think a lot of people have been hurt, or they've had to sell down because they've felt that pressure.
Yeah, it does, I think, require a bit more planning for the future than shares.
Market risks. I'd say there is obviously market risk. So I think, again, research sort of negates that. Interest rate sensitivity. So when those rates went up quickly, that really impacts cash flow significantly. Again, time consuming. I think, what's your time worth? It can be time consuming if you buy the wrong asset. The idea is you get a really good property manager, you forget about it, you get a valuation every year, you watch the property grow, you watch the rent grow.
Yeah, get on with your life.
Get on with it. High entry and exit costs, stamp duty, legal fees, real estate agents, buyer's agents, time costs.
This is a massive negative for property, actually, the entry and exit costs. Well, exit costs, really, capital gains tax is the same.
And it's selling agent.
It's that, the selling agent's only 2%. But the CGT is going to be, if you have picked the right property and you've got some capital gain, that's the big exit cost. But stamp duty on entry, that hurts.
Well, it's a recycling cost, isn't it? Where am I going to allocate that money after I sell?
Yeah, and there could be a lot of property investors who say, well, I just plan to hold forever, so I'm not paying any CGT compared to maybe the share trader. If they are trading, if they do plan to sell, then they are going to experience capital gains tax.
The optimal time, again, ideally you'd want to hold, but if the optimal time, if you did sell, would be in a year maybe when your taxable income will be a little bit lower. Let's say you take a year off, or maybe you're closer to retirement, you might want to go, you know what, I'm under a bit of pressure here, and you might offload. But again, we'll talk a lot about recycling costs in a future episode when we do talk about, I know there's a lot of commentary around sell a property now. Like a lot of the podcasters are doing that now. When to sell, when's the best time to sell. So that's something I think we need to touch on in the future.
Oh, yeah, we'll definitely cover that. And,
so if people want to see that, comment in the comment section.
Yeah, it won't be opinion-based. It'll be data-based.
Data-based. Tenant vacancy risks. Actually, this is one I've heard a lot before. I've had a bad experience with tenants. And one thing I find is that a person has a bad experience and that's it. Oh, property's horrible. I've had this issue. The tenants are hopeless, this and that. But that property might have had a ton of massive capital growth.
Yeah, I had a friend who she had a unit, and the body corporate fees were exorbitant. They were quite high, maybe $1,000, $1,500 higher than what I would have expected is normal. But she wanted to get rid of the property for that reason alone. And I thought, what a trivial thing to look at. I mean, it is like $1,500 a year, but you're talking about something that's worth over $500,000, and if it's giving you good capital growth, it just trumps all the expenses.
Well, that's what you pay a property manager for. That's what they're there for, to find the right tenant.
This was body corporate.
Body corp, sorry,
Yeah.
body corp, a different story. But I guess back to the tenancy and vacancy risks, you can negate that risk. Like I said, buy a property, you forget about it, hopefully.
Yeah. So first of all, you vet your property manager, make sure you've got a good one. And then you, of course, have landlord's insurance, so you're protected there. And just don't get too greedy. You know, if the property manager tells you, oh, we can get 500 a week for this, ask them, well, how many people, how many applicants do you think you'll get? If you're going to have an open inspection, how many people do you think you'll walk through with a $500 a week asking rent? Can we just lower it a little bit, get more applicants so that we've got a good one who's not going to kick holes in the wall and do a fly-by-night?
And I think back to the point that I made before about someone has a really bad experience like with the tenants and they get fixated on that. It's a normal, isn't it? As human beings, like I find that in the past I found myself being guilty. I heard something that must be correct or I've read a book, but I find you find your own way. You sort of experiment, see what works for you, what doesn't work for you. It's similar to like someone saying Teslas, they're rubbish, EVs, no good, because they've seen something on Instagram and that's it. It's the worst thing ever. But they don't look at all the positives of it. Like you need to look at things at different angles, but at the end of the day, what works for you? And everyone everyone's got their own opinion and that's okay.
Can I tell a story about my first tenant? My first investment property I purchased had a tenant in there. As soon as they moved in, he lost his job. They stopped paying rent. It took me almost 6 months to get them out. They left the day before the sheriff turned up. They were so nose out of joint about the whole thing of being evicted. They blocked up all the drains and left taps running overnight. And the insurer just gave me sort of some token like payout. They didn't cover the whole expense. That was my first property investment experience. But I remember a year afterwards getting some local agents in to give me a free market valuation. And it just covered over all of that because the capital growth was so spectacular that it just made all that clean up after their exit seem trivial.
Did you initially think, oh, what have I done buying a property? This is a nightmare. Because it's so easy to get fixated on those small things. Like you have to look at the bigger picture and go, I'm buying this asset. I'm going to looking for that growth. That's what I'm after here. And cash flow obviously behind it eventually. But it can deter you, can't it?
Yeah. But and I can't remember my feelings at the time. Just stress and I've got it now. I've got to do something with it. I've got to make this work. But then after getting those appraisals and the refinance, it was right next. Let's do this again. But I'll be smarter next time. I won't get such a terrible tenant.
You've learnt your lesson. That's the key. You've learned the lesson. A lot of people don't learn their lesson.
I pride myself on never making the same mistake more than about half a dozen times.
The maintenance can be high. So I think, look, if you're buying an older property, you're expecting for things to happen. Like there's going to be things that you're going to need to change, hot water systems. There might be bits and pieces. As long as a property's structurally okay, all those bits and pieces, like, again, you can get fixated. You get a building a pest, oh my God, it sounds so bad. But it's like the asset, that land, the suburb that we're after, in a year's time, you'll forget about it.
Yeah.
But it's so easy to get fixated on those small things.
Yeah, growth trumps everything in property investing.
Property expenses, I know we've done this on an earlier episode, but fixed and recurring expenses, so things like interest, repayments, council rate, strata, could be land tax if applicable, property insurance, property management fees, if you're using an agent, ongoing fees, like maybe with the bank, annual fees, all those bits and pieces, and variable and one-off. So I'd say maintenance, maybe some repairs, vacancy, depreciation I factored in as an expense because it is an asset going down in value. So they're all the property expenses you need to factor in. So when you are comparing both of these asset classes, you need to factor in expenses.
Yeah, I guess that's one of the pluses for shares. You don't have a lot of those expenses.
Buying and selling costs. So as we mentioned, buyer's agent fee, property costs, your time in learning, they're all critical factors. And look, there's good and bad in all. Like there's, I think, great buyer's agents and not so great buyer's agents. I know there's a lot of property courses out there. Some are good, some aren't that good. So you need to, again, find your own way. That's the difficulty, isn't it, Jeremy?
Yeah, it's just, it's like that with everything. There's good and bad. You've just got to do your research.
Stamp duty, legal fees, loan establishment fees, capital gains, exit, discharge fees, maybe depreciation report, real estate agent fees. There's a fair few fees there that you need to account
there's a
for.
lot more with real estate. Isn't
Shares, brokerage, could be $2. That's it.
there? $2, really?
$2. Yeah, some of them, I think some of them do even free, or they were doing free. Shares, pros, I'd say high liquidity. You can sell whenever you like and have your money within 3 business days, typically. Diversification, so I could buy a Commonwealth Bank stock, I could buy a Woolworths stock, I could buy Zip shares, I could buy, I could diversify quite heavily with shares for minimum amount, like hundreds of dollars.
But it's interesting, despite that diversification, like you were saying, those index funds, they still may be more volatile than a single property in a state capital.
That's, correct. And I guess the thing we've got on our side is you can look at the data and we can, if we're looking at averages, we want to outperform the average. Like that's what we want to be known for, that we can outperform the averages over time. Higher long-term returns, higher. We'll have a look at this in part 2.
Part 2, yeah.
Because when you look at it just from a like for like, you think, oh, okay, that maybe shares is in front, but part 2, you have to wait out, everyone.
Yeah, sorry, there's too much in this to do everything now. So
management fees can be, I wouldn't say it's even management fees, or they could be. Like typically with these, for example, Vanguards, they're really low. I know some of the other ones like the A200, that's like beta shares. I think it's like 0.04%. You need to check that, but the management fees are really low because all they're doing is it's just all bundled up together. There's no one picking and choosing.
Right, so the fund manager isn't as active.
Where they would be active in a lot of super funds, the long-term return might be around, let's say, 8%, 9% total returns, give or take, but that's including growth and income. But you're paying a management fee typically with a lot of people don't even look at their superannuation, but it's your money at the end of the day. When you retire, you'll have access to that. So you want to make sure how it's actually performing. Yeah,
well, one of the things that triggered me into investing was I would get these letters from my super fund manager, and dear Mr. Shepherd, here's how much of your money we've lost, and here's how much we've charged. And I thought, gee, this money's better off in my hands than theirs.
I've just had a flash. Well, that's right. It is. You can do it yourself. Like I've actually taken a bit of an active approach with my super, but back to a point that you made with your property manager a long time ago, I also went through 3 property managers for a property once. It was a nightmare, but a learning experience. And I love the email that I get through. Oh, congratulations, we've had 0 people go through the property. It's like the automated email. I'm like, are you serious?
Congratulations.
For 0. You have to laugh. You got to laugh. You can't be too serious all the time. Flexible investment amounts. So again, you don't have to start with huge amounts. Low entry costs, like brokerage fees pretty much is the main thing there.
Yeah, actually that's a big one for shares v property. The low entry.
Low entry.
Like starting out, I reckon, surely you've got to dabble in shares, don't you?
Yeah, one thing I did notice working with a lot of clients is, let's say you're gunning for that first property and you need a deposit of, let's say you're working towards 70 or 80,000 to try and get into the market to buy that first property. Now, the risk investing in shares is that it's higher risk and higher return than just keeping it in a high interest savings account. So it's like a matter of, do you just park all your money in a high interest savings account with no risk? Or do you take on a little bit of that risk in the share market to try and get into the property market? But the downside is if the share market tanks, you're a bit further away from that property.
Yeah, I think the big learning experience of investing in the share market is preservation of capital. That's the game. How do you not lose everything?
That's it. And I think it's a bit about asset allocation, where you can sort of put your money. Dividend income we've spoken about. No ongoing maintenance. So pretty easy to buy, forget about.
Shares don't require any maintenance.
Well, it's just you buy it, you can forget about it if you like. It's like our super. A lot of people don't even think about it, do they?
Yeah.
Franking credits, again, we won't talk about, you could talk to a financial planner or your accountant about this, but franking credits are pretty much when you get a dividend paid from, let's say, CBA. If it's fully franked, they've already paid tax on it, and then your taxable income will sort of increase, and then you get credits back. Again, we look at it, I think, in part 2 or part 3 in the series, a bit about franking credits, but we don't go too far. into it.
It's the ATO not double dipping on tax, isn't it?
Correct. And it sort of favors more people that are that need more cash flow or are sort of lower income earners, because the credit is a lot more powerful, I would say. So it could be, let's say I'm getting closer to retirement or my taxable income's lower. But again, talk to your tax accountant about that. This isn't tax advice. Shares, cons, I'd say volatility. We've spoken about that. Average returns of the market. So that's most probably one, isn't it? You buy into these vanguards. And look, another one, VGS, which is like the world markets, like the American markets, the US markets, and obviously all the other markets, Asian markets, all around the world. They've had really good returns the last 12 months. If you Google VGS, it's done really well. If you want something specific to the US, you've got VTS. So depending on what your risk profiling is, but a lot of it does get average return of those markets because they're bundled up companies. What we want to do as property investors is outperform. And I'm not going to say that I can do it with shares because I can't.
Okay, so you either buy in one of the indexes and then you're just going to get
The
average returns.
And there's nothing wrong with that because it's you having lower risk.
Yeah, you have lower risk. Or you take on the higher risk, do everything yourself, trade.
Buy a penny stock.
Yeah, small caps. And then you might be able to outperform the market, but you probably won't have the LVR, the high LVR.
I think it's just all about strategy. I'm sure these professional traders or active traders, they've got their strategies in place. They know when to sell. They know when to buy. They do option trading, which we won't talk about, or they sort of can leverage. So they do everything. Emotional investing. So this is a big one. It is. I was buying, selling, checking every day.
Every day.
And when you got a busy life, you don't need something else taking your extra brain capacity up.
Yeah, and you hear something on the news and you might think, oh, should I be selling? What have I got to look into? What have I got to research?
No leverage like property. I think we've discussed that. But there is, I think, good leverage in certain funds like some of the vanguards. Less control. You can control, I guess, how much exposure you've got to different asset classes, but I would say you don't have any influence over a company.
Yeah, I think the point you're trying to make there is that if you've got a property, you have hired a manager to look after it for you, but you are limited to some extent by what the market's going to do there, but you do have more control, whereas in the share market, if you've got some stock, you can exercise control by selling it, or you can vote at the AGM, but you are one of thousands of other voters.
I'd say market risks, we've spoken about tax on gains, but that's the same for property or any investment or business. Like that's just the normal thing. So it's just normal paying tax.
Yeah, they're the same, aren't they, really?
Income inconsistency. Look, with the index funds, I think they're a little bit more stable. But as an example, if you have a portfolio of just purely stocks, a company can easily just cut their dividend.
Before you go on further with, the income inconsistency, we did say tax on gains. The CGT laws are the same for shares and for property, but there'll be some property investors out there who their plan is to buy and never sell. I don't know if that's the case with share owners. Would they have that view? Oh, I'm just going to own forever. So they are more likely to run into a CGT liability than your bog standard property investor.
That's right. And I think another thing is like there's this always argument about dollar cost averaging, or do you put all your money in one lump sum? And I'm going to talk about my experience, I think in part 3 of the series, about what I did, and it didn't work out the best, but that's what we're here. We want to be transparent and we want to provide value in the experiences that we've had and try and educate someone else listening. But where was I going with that? But I guess, for example, some of the index funds like with Vanguard, like their yield they are sort of higher long-term compared to maybe some of the overseas ones. So the overseas ones have more growth. So if you're, let's say in a higher tax bracket and you don't really need cash flow, do you need that higher dividend yield from an index fund of, let's say, 4%? You might go, look, I want to target more growth because on that dividend, you're paying tax on. But if you're in your accumulation phase, maybe you want to go for more of that growth earlier. Can be time consuming. I've touched on that. I've spent a lot of time on that. I'd call it experience.
Okay.
No value add. You really can't add any value, can you? Unless you're
right, yes.
Unless you're the director of the business or CEO running it and you know something that others don't.
Yeah. So with the property, you can renovate to improve value. You can, change the rental income. You could maybe refit the garage into a granny flat, or put a granny flat out the back and increase rental income.
This is some factual numbers, I guess, on some, share expenses, or I'd say index funds. So these are the bundled up shares that I mentioned. So for example, like VAS, very popular. It's a Vanguard. It tracks the top 300 companies with strong dividend yields. So management fees very low, 0.24%. You've got VGS. It provides global diversification with over 1,500 US stocks, 0.18%. So very enticing. When you're looking at these low management fees, you're thinking this is pretty good. VTS tracks the entire US stock market with ultra low fees, but no exposure outside the US. So it's just purely US. That's why I sort of me personally like the VGS. It's like it bundles everything together. So if you get VAS and VGS, it sort of bundles it all up. And then you got VDHG, which is ultra diversified pretty much. So combines Australian and international markets. So it brings it all together. So if you're big on like the US market, someone might go, I might go to VTS as an example. So it just depends on your strategy, your goals. But you can see here, but then if you go to like these fund managers, they can charge a lot more. Could be 1%, 2%, 3%. They're trying to beat these index funds.
Right.
I think Warren Buffett's spoken about it, and professionals said it's very hard to beat long-term the averages. Brokerage fees, management fees for, I guess, the fund managers, ongoing platforms, but the fees aren't that high, I'd say, with the shares. The tax we've discussed, the dividend, foreign exchange. If you're buying some overseas stocks, currency conversion, bid and ask price. So you might buy it at a certain price, but there might be that sort of little bit of a difference in the ask price when you do buy an index fund. So you might be out of pocket right away, but you're not looking to make a quick dollar within 10 minutes, are you? Like I think that's how a lot of the crypto platforms work. They're always sort of taking that clip. They all take the clip, Jez.
Yeah, everyone wants a clip.
Everyone wants a clip. Slippage costs, what did I mean by this? So order execution, so different price points. Like you buy it, let's say $3, but you might be paying $3.10, for example. ETF, so management expense ratio, so the ongoing percentage of the fund managers. So you can see the Vanguards are pretty low there. So I think you can see here clearly property versus shares, expenses are a lot lower with the shares, aren't they? Conclusion to part one, Jez. So leverage drives a lot of the property growth it drives a lot of the property side of things, doesn't it?
Yeah, well, a lot of these points, some people would be aware of already, and they may think they're kind of obvious, but I'm really looking forward to part two because
we dive in.
Yeah, that's where we're going to get into some actual numbers, looking at history, looking at the data, do some calculations, and hopefully compare like with like.
Can I be honest? I thought this episode was going to go for 15 minutes. It's gone for a lot longer than that. I always say that, I'm like, this is only going to go for 15 minutes. And then we just start talking and it goes over a bit. The other one, shares provides definitely higher liquidity and flexibility. I think that's a big, big plus for the shares. The best choice, I think, depends on your goals and risk tolerance. So again, you can talk to a financial planner, or there's so much education. You can learn yourself, and you can even talk to ChatGPT if you want. Ask the right questions.
Yeah, I think that's the important part.
Asking the right questions is key.
And you've also got to be aware that ChatGPT is getting its knowledge from the internet. So if there's a whole bunch of BS out there, it'll just regurgitate.
And even from a data perspective, when I was looking at certain things, it was wrong. I picked up on. So I'm just saying more from, hey, like maybe this is where I'm at. This is what I'm doing. You might ask certain questions to help yourself out. Or you talk to a financial planner. But again, similar to anything, there's good financial planners and there's some absolute horrible financial planners out there. Same with accountants, mortgage brokers, doctors, data analysts. So in part two, we're going to discuss returns and performance over time between the two, which I'm looking forward to. But Jez, where can listeners go for more resources?
So if you subscribe, you'll be notified when part two comes out, and give us a thumbs up if this is what you're interested in. So this is really just laying the foundation. Where I get excited is part two, where we're looking at data, and then there's a part three as well.
And when we look at part one, part two, part three, if there's anything that we've missed, because we can't get it right, like it's just us
There's a
two.
lot in this.
We're
We've
trying to
got-
figure it
yeah.
out, and we've got the business to run and everything else. So we spent, like, this isn't a 3-minute job. Like, I've spent some time, and there might be a gap. And if there is, put it in the comment section. We want to hear from everyone.
Yeah, we can flush this out. Maybe by the time we're recording episode 3, someone will be giving us enough feedback for an episode 4.
Yeah, that's right. So everyone, subscribe, like, share to the world. Thanks for tuning in, and see you in our next episode. Bye for now, and take care.